Hi everyone! In this video, I will introduce the Cox-Ross-Rubinstein binomial option pricing model. It is a generalization of the single period to a multiple period binomial tree. T0, Tn is a partition of time between 0 and t into n plus 1 dates and n periods. We assume that there is no arbitrage. We consider a financial market composed of two assets. One risky asset S, for example a stock which can go up with a probability Q by a factor U and down with a probability 1 minus Q by a factor D at each period with D equal to 1 divided by U, we assume it is not paying any dividend. And one risk-free asset, B, like a zero coupon bond, with R, the continuously compounded risk-free interest rate. The risky asset value is S0 at t equals 0. After one period, it can go up to U times S0 with a probability Q, or down to D times S0 with a probability 1 minus Q. After two periods, it can take three values, U square times S0, U times D times S0, and D square times S0. And after three periods, it can take four values. After n periods, it can take n plus 1 different values, and we get the lattice representation of the different values of S in our binomial model. The value of U and D are chosen from the volatility sigma of the stock. The volatility is a measure of the variation of the price. It is often defined as the annualized standard deviation of log returns. Assuming the average is equal to 0 and the volatility is constant, we get the following expression using the log return over one period of time between t and t plus delta t. The expectation of the square of the log return is equal to the square of the log of u. Delta t is equal to t divided by n, so we deduce that u is equal to exponential of sigma times the square root of t divided by n, and d is equal to the inverse of that. Similarly to the single period case, in order to avoid an arbitrage opportunity, we must have exponential RT divided by n between D and U. And the risk-neutral probability Q is equal to exponential RT divided by n minus D divided by U minus D. We can easily demonstrate that the discounted asset price is a martingale under the risk-neutral probability measure Q. The conditional expectation of the next value is equal to its present value. I let you show that in an exercise. Again, similarly to the single period case, the price of a contingent claim C with underlying asset S and expiration date T is equal to the discounted expectation of its final payoff under the risk-neutral probability Q. The discounted price of the contingent claim is a martingale, and we can deduce the price at time ti from the discounted expectation under the probability Q of the price at time tj, with tj higher than ti. If there is one period, the contingent claim can take two values at maturity, Cu and Cd, and its value at t0 is equal to the discounted expectation of the payoff at t. We also know the value of the delta, which corresponds to the number of underlying contracts that has to be sold in order to offset the risk associated with the price movement of the underlying asset. If there are two periods, there are three possible values for the final payoff of the contingent claim, CUU, CDU, and CDD. We calculate the two possible values of the contingent claim at T1 as a discounted expectation of the final payoff. And similarly, we calculate the price of the contingent claim at T0 from the two possible values at T1. The price at T0 can also be directly expressed as the discounted expected value of the final payoff. In a multi-period market model, the delta is no more constant. So we need to delta hedge the contingent claim dynamically in order to offset the risk related to the underlying asset. Here is the general price of the contingent claim in a binomial model with n periods. This is the discounted expectation of the final payoff, the stock price, and so the contingent claim can take n plus 1 different values at t, and it follows a binomial distribution. This is the probability of having I up and n minus I down in n movements, the probability of a movement on the upside being q. We can also get the price of the contingent claim with a backward recursion. We start with the n plus 1 boundary conditions at maturity t. Then we deduce the n prices at the previous date, and we continue until j equals 0. For j equal to n minus 1 to 0, we deduce the price at j from the price at j plus 1 with the following backward recursion. Thank you for your time.